Hello, I'm Andrew Montesi, and welcome to another edition of Industry Leader Insights, where we explore the topics and trends shaping the future of our industry. Now, over the next few weeks, we are putting the spotlight on one of the most important topics in reverse mortgages, and that's property data. Housing equity, demographics, affordability, home values, and market intelligence all influence the opportunities in this industry. But understanding what the data actually means is becoming just as important as accessing it. To kick off the series, I'm joined by Aaron Wagner, Head of Data Science at ATTOM, the leading provider of property intelligence in the United States. Using ATTOM's Q1 Home Equity and Underwater Report as a starting point, we go beyond the headlines to explore what the latest data is really telling us. We discuss why today's moderation in housing equity looks more like market normalization than a warning sign, why the Midwest has emerged as one of America's strongest equity regions, while some former pandemic boom markets cool, and what reverse mortgage professionals should focus on when interpreting the growing volume of housing data available today. Then next week, in part 2, we'll shift our attention to the future, looking at where housing equity may be heading over the next 5 years, the regions best positioned for long-term growth, and how artificial intelligence is transforming the way property intelligence is created and used. Let's get started with Aaron Wagner from ATTOM. Well, Aaron, thank you for joining us.
Yeah, thank you. It's a pleasure to be here.
Just wanted to get started by maybe just giving us a little bit of context for ATTOM, your role, and perhaps why your data really matters to housing in our industry.
Yeah, great. Happy to do it. I would say ATTOM is really a definitive source for U.S. real estate data and property intelligence. So we cover more than 160 million properties across 90 plus data sets, so quite a bit of breadth. And that's 99% of the US housing population. And those data sets include things like property tax records, deeds, mortgages, foreclosures. We even go into environmental risk and location data, like our own proprietary neighborhood data. And all of that's linked together by universal identifiers and quality controlled at scale. So it's a really great operation. And then on top of that data foundation, we have an intelligence layer. We produce AI-driven analytics like our automated valuation model or AVM, hyper-local price indices. We go all the way down to the block level with those. And we generate a lot of reports like the home equity and underwater report that we're talking about today. I'm sitting as the head of data science at ATTOM. So my team builds that intelligence layer, including the various model components that power the report that we're going to discuss today. And I think this matters for the audience because a lot of value rests in kind of the layer between raw data sources and the end consumer. For example, deeds come from more than 3,200 county recording offices in the United States. And every county does things its own way with different quirks. And our engineering and data science team turns that patchwork into clean intelligence, which allows you to glean insights and take actions based on the best possible information.
Well, yeah, what a time to be alive in tech and data at the moment. Your team must be very busy, that's for sure.
Definitely is. Yeah, it's a good time though.
Absolutely. Now, what about looking at the report that we've talked about in terms of equity and underwater report? One of the phrases that we hear often is equity rich. And what does that actually mean? And how do you guys calculate that?
Yeah, so we define equity rich as a loan to value ratio of 50% or lower. So that means the owner holds at least half the home's value as equity. And in the report, we define another term, seriously underwater, as a loan to value of 125% or higher. And that's where the owner obviously owes at least a quarter more than the home is worth. And we get those categories from the bottom up. So we start at the individual property record. For every mortgaged residential home in the country, we estimate a couple numbers. The first is what's owed. So our loan model reads publicly recorded mortgage information, deed of trust documents, and we estimate the position and balance of every loan on that property. And then the second is determining what the home's worth. So our automated valuation model We're leveraging all of history, so 30 plus years of historical transactions, especially recent comps and market trends to come up with a highly accurate estimate of current market value. And then once we have those two components, we just divide the debt by the value, and you have that loan to value ratio. We do that across the entire residential housing population. And from there, roll-ups are pretty straightforward. And so we aggregate at the zip code level, county, metro level, state, and national level to get the numbers we're discussing. And then just one quick caveat. So we really like to distill down to the essentials. So we deliberately narrow the report to the traditional consumer homeowner. So we exclude investor transactions where a single loan might be an entire portfolio, for example, because those would distort the loan to value ratios. So that's just the business insight that we're able to deliver with some of our engineering.
Okay, that's really good. Now, coming to that report that we talked about, many of our viewers would have taken a close look at that Q1 2026 home equity and underwater report. Main headline was obviously that share of equity-rich homes declined nationally. But going deeper, what stood out to you most in the data?
It's a good question. I'd say a few things, maybe three things. First would be the breadth. So this is a national dynamic, not really a localized trend. So the year over year equity rich share declined 86% in major net, in 86% of, not 86% down, but 86% of major metros saw that shift down. And our seriously underwater share rose in 45 states. So when a move is that uniform across the map, it's really telling you that the causes are national. For example, based on rates and prices, not any one region's issue. And second is the map really reversed. So states are giving back. The ones that are giving back the most are the pandemic boom markets like Florida, Arizona, Colorado, North Carolina, Texas, for example. Those were the ones that gained the most during the pandemic, so they're giving back the most in terms of equity. And the ones that are gaining, there are a handful of states where the equity-rich share increased from last year. Those are really steadier, more affordable markets that never overheated. You could think of something like Illinois or Wisconsin. And finally, I think the third was regional. So the deepest equity in America right now is in the Midwest. So 22 of 30 of the most equity-rich counties in the country are in the Midwest. 11 of them are in Michigan. I thought that was interesting. So that's not a price boom story. In those counties, the debt side of the equity equation is really doing some work. So affordable homes owned for decades with a larger proportion of mortgages largely paid down. So I thought that was an interesting story.
Yeah, that's really interesting. I mean, it connects to my next question, which is this: are we seeing a normalization post-pandemic, or are you looking and seeing signals that could perhaps be a more meaningful shift than just that simple train of thought?
Yeah, so I'm pretty emphatic on this one. I think the data makes a strong case for normalization. The key really is when I'm always taking a step back and remembering how abnormal the pandemic boom was. So from 2000 to 2022, we saw the fastest home price growth on record in major national indices. That's roughly 40% a national increase in about 2 years. And that's beyond anything that the mid-aughts during the run-up had. So that's really what drove equity to record levels. We started around 27% of mortgaged homes being equity rich before the pandemic to almost half at the peak. So today we're sitting at 43% nationally. And so we're back to where we were in the late 2021. But that's still some 16 points above the pre-pandemic norm. And it's higher than at any point before late 2021. So it's a strong case. And we also see seriously underwater edging up. It's up to 3%. But before the pandemic, 6.5% was normal. So the pace is steady as well. It's not accelerating. So it's pretty strong case for normalization. And a meaningful shift would look very different from what we're seeing in this data.
Yeah, okay. Yeah, it's interesting. So, I mean, maybe zooming out again, in terms of, for reverse mortgage professionals, what should they really be paying attention to when it comes to interpreting housing market and equity data? We got so much data out there, so much noise. Like, how do we actually work through all of this and make sense of what really matters?
Yeah, that's a really good question. I really appreciate that question as a data science as well. I'd say a handful of things. My biggest one would be to urge professionals to go granular. A lot of the national numbers will not completely capture the dynamics of your target market. So, for example, just think about the scope of things. Equity rich shares are running from about 6% to 95% across counties. And if you just take an example market like Miami, if you look at zip codes, the equity rich measures range from about 30% to 75%. And even in a year like this past year, 31% of counties increased their equity rich share. So the opportunities and kind of the inference that you're drawing will live at the sub-market level. So I'd encourage you to look there. And then kind of the counterpart to that granularity is patience. So local numbers being smaller and kind of sourced at very fine geographic levels, you're going to want to check those for stability. You're going to want to make sure quarter over quarter there are no serious jumps. So we do a great job of distilling that information, but it's always wise to make sure that you're not trying to pounce on something that's not part of the global trend. So you want to make sure there's stability in those numbers. Two specifics from our own data worth knowing is like just when you're looking quarter to quarter, there's always seasonal volatility. For example, every Q2 comes in higher than Q1. And so you just have to make sure that you're comparing like with like. And the reason we're confident in this year's moderation story that I mentioned earlier is that both measures moved in the same direction for 3 straight quarters. So there's always that stability that you want to bake in there.
Yeah, it's brilliant. Well, thank you so much, Aaron. We're going to continue this conversation in part 2 and maybe get your little crystal ball out and see where things are going to head in the next few years.
Happy to do it. Looking forward to it.